In this presentation, we will discuss the process of an auditor obtaining an understanding of internal controls. So we've discussed what internal controls are. We've discussed the fact that the internal controls are the responsibility of management. We've discussed the factors for management to set up a good system of internal controls. Now, of course, we'll be thinking about those internal controls from the audit side of things. So we, on the audit side of things, need to have an understanding of what good internal controls are, and therefore be able to audit whether or not, think about whether or not the company we are working with have implemented the internal controls well. Therefore, as we consider the auditor's objectives on the internal controls, or us reviewing the internal controls from the auditor's perspective, we're going to go through some of the similar points that we've seen in the past as we thought of what good internal controls are, but now, of course, from the perspective of us auditing and thinking about whether or not we as auditors can rely on the internal control system set up by management. Auditor will obtain an understanding of each of the 5 components of internal control to plan the audit. So we had the 5 components of the good internal control, including the control environment, the entity's risk assessment process, control activities, information and communication, and monitoring. We, as the auditor, now going to go look into those 5 components and get an understanding of each. Our objective is to identify types of potential misstatements, identify the factors that affect the risk of material misstatement, and design test of controls and substantive procedures. So, of course, our goal is to get an understanding of the internal controls in order to identify types of potential misstatements to see if because our objective as the auditor is to determine whether or not the financial statements are put together in accordance with a set of standards such as generally accepted accounting principles, identify those factors that affect the risk of material misstatement. Once we have an understanding of that, we can design tests of controls, whether or not we want to further test the controls to see if we want to rely on them, and or the substantive test, the actual groundwork testing, the main, larger portion of the testing we would need to do within our audit process. Understanding internal controls includes an understanding of the control environment, the entity's risk assessment process, the information system and communications, control activities, the monitoring of controls, those 5 components. Documenting the understanding of internal controls. Our documentation of the internal controls will take various forms, including procedures manuals and organizational charts. We'll include things like flow charts. We'll have internal control questionnaires. So when we have the questionnaires for internal controls, and the narrative description, we'll have a narrative description of the internal control. So as we think through and process through the internal controls, you can imagine us looking at these types of objectives and trying to document the evidence. And remember, we're trying to get an idea of the internal controls. We want to gather evidence related to the internal controls depending on that internal controls for the opinion that we will give. Therefore, we're going to imagine filling our buckets up of the evidence that we need to gather in order to issue a good opinion. And these are going to be types of things that we can put together in order to fill that bucket up, in order to provide us with evidence with relation to the internal controls. You can imagine the internal controls aren't always the easiest thing for us to test. So they're going to have some subjective nature. So part of our analysis of the internal control are going to be things like interviews, and therefore we want to know what the organizational charts will be. We can have flow charts within the process. What are going to be the internal control process? And we're going to have things like questionnaires and possibly a narrative type of format in terms of what our results were when we went through things such as inquiry. Now, note that the entity size and the internal control, as we've mentioned a few times in the past, will be a factor. If we have an entity that's going to be small in nature, we would expect the internal controls to be small and therefore not be able to rely on them. If we have a larger entity, publicly traded company, for example, we would expect the controls to be strong, effective internal controls. So just remember, if you're auditing someone that's going to be smaller, if you're working for a smaller firm that audits, say, a particular niche or something like that, as opposed to a larger firm that's auditing publicly traded companies, then you may well be in a situation where you cannot rely on the internal controls totally. They should still have some internal controls, but you probably won't be able to rely on internal controls in the same fashion because they just don't have what would be necessary to implement strong internal controls. They don't need them. I mean, they can't do them and be cost effective at that level. And as a company gets larger, they really need to do them in order to safeguard against large risks that could result if they had not implemented sufficient internal controls, and therefore we as the auditor can depend on them more likely in the large organizations. Limitations on internal control. Now, once we set up the internal control, we need to have an inherent idea of the inherent limitations within internal controls. Although we will rely on internal controls, we can't rely totally on them. We can't rely totally on things like checks and balances because there's still problems. One main problem is collusion. You'll note that collusion, is kind of like a bad word for communicating together because what it means is the separation of duties usually means that we're trying to separate duties so that it would take multiple people to commit a fraud. So if someone committed fraud or even an error, it would take multiple people to commit a fraud. Now, if people wanted to intentionally commit a fraud and they went around the separation of duties by colluding, by talking to each other, and then planning to basically commit a fraud that could be committed if only one person was in charge for two types of system items, including, say, recording and possession of something like assets. If one person was in charge of that, they can basically have a higher likelihood of committing fraud and not having a problem or not being caught. If we have a separation of duties, there's less likely they'll be caught. But if they collude together, plan together, and then commit fraud together, that's going to be something that internal controls cannot typically eliminate entirely, that kind of problem. Then we have human errors. Obviously, there's always a problem of human error, even within a good internal control system. Now, a good internal control system will limit the human error because that's going to be one of our objectives. So a good system will be able to catch more human error. That's going to be one of the things we do, but human error is always going to be a problem within a good internal control system still. And then the management override of internal controls. To an auditor, this is the most concerning for us. And that's why we're really concerned with, on the front end, whether we're dealing with management, and when we consider the control environment, we're trying to see if people at the top have integrity, and if they basically are going to be implementing the internal controls well throughout the organization, if they feel that a strong internal control system is good. Why? Because if management wants to circumvent internal controls at the top level, they can basically do so because they're the ones they don't have you can't really have separation of duties from top management. They're the ones that are in essence enforcing, so they can go around that separation of duties. So this is going to be from a high problem in terms of the financial statements being materially misstated. This would be the one that would be kind of most concerning from an audit perspective. Hopefully, we're again dealing with clients that have good board of directors, good oversight, and management with integrity. Those are the type of clients we're trying to pick up. But that's going to be the one of these factors that could result in the largest misstatement would typically be this one here. Assessing control risk. So when we as auditors go through the assessment of control risk, remember we're going to set control risk high or low, and that's going to help us to determine how much substantive testing we want to do. So we're going to identify specific controls relied on. What are the controls that are being relied on? Then we're going to perform tests on controls on them. So we'll actually test those controls. We're going to be doing testing of the internal controls as opposed to substantive testing of accounts and assertions related to transactions, testing the controls, and then we're going to conclude on the achieved level of control risk. Then we're going to make a conclusion. We're going to say how strong or weak we think the controls are, whether or not we can depend on them. That being our assessment on the control risk. That'll help us to determine the amount of substantive testing we will need.